Hello friends, welcome back to the fourth and last video of our mock test covering fourth module of paper Indian Economy and Indian Financial System of JAIIB. I am glad that you found the last three videos of this series extremely beneficial. Now those of you who missed the last three videos can watch them from the links given in description of this video. As usual in this video also we will cover mostly conceptual and many case study based questions. Now friends, time and again I repeat that level of JAIIB examination has changed and now IEIFS checks your concepts rather than simple facts. So from whatever sources you are preparing, just focus on concept based questions as well as case studies. But before we start, don't forget to get your JAIIB Masters pack from the links given in description of this video. Now this is a pack of 4 power packed books. All these are 1000 series question banks of IEIFS paper, principles paper, accounting paper and lastly retail banking and wealth management paper. Now all these books contain super special 1000 plus questions which are very important for your examination. All the books contains real exam level questions and that too with updated difficulty level. These are chapter wise question banks, so it's easier for you to finish this in step by step manner. Not only this, these question banks come with lots of case studies and numericals, and that too with detailed solutions. The best part of this is that you get my full support with respect to any problem or any issue you may face in these question banks. All the links are there in description of this video, so don't miss out on these amazing books. So let's start with today's mock test. And the first question is from chapter Money Markets. And the question goes like this. Which instrument allows banks to adjust cash reserve ratio, that is CRR, and statutory liquidity ratio, that is SLR positions through collateralized lending? And these options are given to you, that is first option is certificate of deposit, then second option is commercial paper, third option is repo and fourth option is treasury bills. Now friends, the correct option for the given question is option C, that is repo. Friends, please note a repo or repurchase agreement is a form of short-term borrowing for banks in government securities. In a repo transaction, one party sells a security to another party with an agreement to repurchase it at a specified date and price. Friends, this transaction is essentially a secured loan, where the security sold acts as a collateral and the difference between selling and purchase price basically represent the interest on the loan. So friends, repos are instrumental in money market as they provide a mechanism for managing liquidity within the banking system. They allow banks to invest their surplus funds temporarily and adjust their liquidity position to meet statutory requirements, such as cash reserve ratio and statutory liquidity ratio. By using repos, banks can effectively manage their short-term credit needs and regulatory obligations. For example, if a bank has excess cash, it can enter into a repo agreement to lend the funds and earn interest, thereby efficiently managing its liquidity. Conversely, if a bank is short on liquidity, it can borrow funds through a repo to meet its CRR and SLR requirements without selling its assets. So friends, this flexibility makes repos a crucial tool in maintaining the stability and fluidity of financial system. So friends, I hope the explanation is clear to you. The next question is from chapter Capital Market and Stock Exchanges, and the question goes like this. In the context of equity markets, an investor encounters a company's red herring prospectus, that is RHP, during an initial public offer, that is IPO. The red herring prospectus does not specify the final price of the shares but includes a price band. Which of the following best explains the role of the book building process in determining the final issue price? And how does this process impact investor participation and market efficiency? And the options given are these, that is first option is, the book building process allows underwriters to set a fixed price above the price band, ensuring high returns for the company at the expense of investor confidence. Then second option is, the process helps discover the demand for securities by collecting bids within the price band from various investors, leading to an efficient price discovery that reflects market demand and investor valuation. Then next option C is, the book building process restricts participation to institutional investors only, limiting the access of retail investors to IPO and affecting the fairness of price mechanism. And last option D is, it sets a fixed price prior to gathering investor interest, reducing the flexibility in pricing and often leading to underpricing or overpricing of the issued shares. So friends, please note the book building process in an IPO involves collecting bids from investors within a specified price band to guess the demand for the securities. Now this helps in efficient price discovery based on actual market demand and investor valuation, thereby leading to a more accurate and final fair issue price. Thus, this process enhances market efficiency by aligning the offering price with investors' expectations and market conditions. So I hope by now you can easily mark the correct option, and the correct option is option B. The next question is from chapter Fixed Income Markets, Debt and Bond Markets. And the question goes like this. A portfolio manager is considering two government bonds with similar credit risk and maturity dates, but with different coupon rates. Bond A has a 5% coupon rate and Bond B has a 3% coupon rate. If the market interest rate decreases by 1%, how will the price sensitivity of these bonds differ, and which bond should the manager prefer if the goal is to maximize capital gains from interest rate movements? And these options are given to you. That is, first option is Bond A will be more price sensitive because it has a higher coupon rate, making it more reactive to the interest rate changes. Then second option B is Bond B will be more price sensitive because lower coupon bonds generally experience greater price changes for a given change in interest rates. Then third option C is both bonds will experience similar price sensitivity as they have the same maturity and credit risk, making bond coupon rates irrelevant. And lastly, option D is Bond A should be preferred as it offers longer periodic income which compensates for any interest rate changes. Now friends, please note in bond investing, price sensitivity to changes in interest rates, which is also known as duration, depends upon several factors including the bond's coupon rate, time to maturity and current market yield. Now there are some theorems in your textbook from this chapter, and one of those theorems says that all else equal, bonds with lower coupon rates are more sensitive to changes in interest rate compared to bonds with higher coupon rates. Now friends, this occurs because lower coupon bonds return less cash flow to the investor before maturity. This means the bond's principal repayment has a greater impact on its price when discounted back at various rates. So when interest rate decrease, the present value of the future cash flow increases, which boosts the bond's price. Now in our question, Bond B with a 3% coupon has a smaller periodic payment compared to Bond A, which is with a 5% coupon. So a larger proportion of bonds B's value is concentrated in the final principal repayment. I hope this point is clear to you. As a result, bond B's price react more significantly to decrease in discount rate, leading to a greater price appreciation than Bond A. So friends, this phenomena makes lower coupon bonds like Bond B in our case more desirable for portfolio managers who are seeking to capitalize on declining interest rate, as they provide a higher potential for capital gains. So the correct option for the given question is option B. Friends, I hope the explanation to this question is clear to you. Now before we move ahead, don't forget to subscribe this channel since this is the only channel that provides quality content. Also join my Facebook group where I post lots of one-pagers, mock questions and other useful stuff which is very important for your examination. You can also join my Telegram channel and connect me on my LinkedIn profile as well. All the links are there in description of this video, so do join after you finish this video. The next question is from chapter Foreign Exchange Market, and the question is, what is the leverage ratio typically agreed upon in Forex trading between a customer and a bank or a brokerage house? And these options are given to you. Now friends, please note in Forex trading, leverage refers to the ability to control a large position with a relatively small amount of capital. The leverage ratio is in fact a key factor in trading because it allows traders to amplify their potential returns, but it also increases their exposure to risk. So the leverage ratio typically agreed upon between a customer and a bank or a brokerage house in the Forex market is often 1:100. Now, this means for every 1 unit of currency the trader puts up, they can control 100 units in the market. I hope this is clear to you. Now friends, this higher leverage ratio is possible due to generally lower volatility in Forex markets compared to other markets. But please note, while leverage can magnify gains, it can also magnify losses, thus making it crucial for traders to use it judicially and manage their risk effectively. Now friends, this specific leverage offered can vary depending upon the broker's policies and regulatory environment. But 1:100 is a common standard in the Forex industry. Thus the correct option for the given question is option C. The next question is from chapter Interconnectedness of Markets, and the question is, how can the contagion effect influence financial stability in interconnected markets, particularly during an economic crisis? And what strategies can financial institutions adopt to mitigate this risk? And these options are given to you. And the first option is, contagion leads to increased financial stability as markets adopt uniform risk assessment criteria, ensuring a synchronized response to crisis. Then second option B is, it results in the spread of economic crisis across interconnected markets, amplifying financial instability. Institutions can mitigate this risk by diversifying their investment portfolios across uncorrelated assets. The next option C is, the contagion effect predominantly impacts domestic markets with little influence on international markets, allowing institutions to focus solely on domestic risk management strategies. And last option D is, contagion reduces the impact of economic crisis by dispersing risk across multiple markets, thus stabilizing the financial system globally. Now friends, the contagion effect basically refers to the spread of economic crisis from one market or region to another, which can amplify financial instability, particularly in interconnected markets. Please note, this effect is normally driven by interconnectedness of financial systems and can lead to rapid and widespread disruptions. Next, financial institutions can mitigate this risk by diversifying their investment portfolios across uncorrelated assets, thereby reducing their exposure to a single market or asset class. Now friends, this helps in managing systematic risk during crisis. So as far as this question goes, the correct option is option B. Next friends, if you are enjoying the content and found it useful till now, then don't miss to like this video, since this tells me that you are loving the content and it also motivates me to make more such awesome content. Also, I would love to connect with you all on LinkedIn as well. You can connect me from the link given in description of this video. Next, let's move forward with our mock test. Then next question is from chapter Derivative Market, and the question is, an investor is evaluating two types of options on the same underlying asset, that is a European call option and an American call option with the same strike price and expiration date. The investor believes the asset price will rise significantly before the expiration date. Which option should the investor choose and why? Now the options given to you are these, that is, first option is European call option because it is generally cheaper and provides a lower break-even point. Then second option B is European call option as it has a higher liquidity and therefore offers better pricing opportunities. The next option C is American call options since it guarantees exercise at any point when the strike price is favorable, thereby eliminating market timing risk. And lastly, option D is American call option because it allows early exercise, enabling the investor to capitalize on the rise in the asset price before expiration. Now friends, please note that the American call option provides the flexibility to exercise the option at any time before or on the expiration date. Now this can be highly advantageous if the investor anticipates that the asset price will rise significantly before the expiration. In fact, this early exercise feature is a key distinction between American and European options, as European options can only be exercised at the expiration. For example, if the underlying asset price increases substantially before the expiration date, the holder of an American call option can exercise immediately to lock in the gains. Now, this allows the investor to secure profits or hedge positions promptly rather than waiting until the expiration date when the asset price might not be favorable. Not only this, the ability to exercise early is also beneficial in scenarios where dividends are expected before the expiration of the option, or when the time value of money, that is the present value of money, is significant enough that the immediate exercise yields a better financial outcome than holding the option until maturity. But friends, please note, while American options typically cost more due to their flexibility, this additional cost is often justified in situations where market conditions are volatile and the investor desires the flexibility to act swiftly. Thus, the American option aligns best with the investor's expectation of a significant rise in asset price before expiration, and therefore making it optimal choice. Now, as far as this question goes, the correct option is option D. The next question is also from chapter Derivative Market, and the question is: a company engaged in global trade expects to make a large payment in Japanese yen 6 months from now and is concerned about the yen appreciating against the dollar. The company is considering using an option strategy to mitigate the risk. Which option strategy should the company employ and why? And these options are given to you. That is, the first option is buy a yen call option, which will provide the right to purchase yen at a predetermined rate, protecting against the yen appreciation. Then second option B is buy a yen put option, allowing the company to sell yen at a favorable rate if the yen depreciates. Then third option C is sell a yen call option, generating premium income that can offset any yen appreciation losses. And last option D is enter into a yen futures contract to lock in the current exchange rate and hedge against the future fluctuations. Now friends, please note, call options give the holder the right but not the obligation to buy the underlying asset at a specified strike price before the option expires. On the other hand, put options provide the right to sell the asset at a predetermined price. Now both options are used for hedging or speculative purposes, offering different strategies depending upon whether the expectation is for price rise or fall. Now in our case, buying a yen call option is the best strategy for the company because it provides the right but not the obligation to purchase yen at a predetermined strike price. So if the yen appreciates against the dollar, the company can exercise the option and buy yen at a lower predetermined rate, thus protecting itself from adverse currency movements. On the other hand, if yen depreciates, the company can simply let the option expire and buy the yen at more favorable market rate, thereby having flexibility and protection without committing to a transaction unless it is beneficial. Thus, the correct option for the given question is option A. Next, let's see why other options are incorrect. Now friends, option B says buy a yen put option. Now this option would give the right to sell yen, which is not relevant for a company needing to purchase yen. So this answer choice does not protect against yen appreciation, but instead would be used to hedge against yen depreciation, which is not the company's concern here. Then next option C says sell a yen call option. Now friends, selling a call option would generate premium income but would not provide protection against yen appreciation. In fact, it could increase risk exposure if the yen appreciates, as the company would be obligated to sell yen at a lower price if the option is exercised by the buyer. And lastly, option D says enter into a yen futures contract. Now friends, while a futures contract would lock in the exchange rate, but it obligates the company to buy yen at a rate regardless of the future market movements. Now this lacks the flexibility of an option, as the company would not benefit if the yen depreciates. So friends, I hope the explanation is clear to you. The next question is from chapter Factoring, Forfeiting and Trade Receivables, and the question goes like this. In the context of TRADS, that is TREDS, and this stands for Trade Receivables Discounting System, what is the nature of transaction processed for MSMEs? And these options are given to you. That is, first option is with recourse to MSMEs. Then second option B is based on collateral provided by MSMEs. Then third option C is without recourse to MSMEs. And last option D is only for export transactions. Now friends, please note the transactions processed under TRADS are without recourse to MSMEs. Now this means that once the MSME supplier has sold its receivables through the TRADS platform, the financier assumes the risk of the buyer defaulting on the payment. On the other hand, MSMEs are not liable for any payment failures once the receivables are sold, providing them with the immediate liquidity and reducing their risk exposure. Friends, this feature helps MSMEs manage their cash flows more effectively without the concern of buyers' delayed payments impacting their operations. So TRADS facilitates easier access to working capital for MSMEs by allowing multiple financiers to bid on receivables, thereby creating a competitive and transparent financial environment. So as far as this question goes, the correct option is option C. The next question is from chapter Venture Capital, and the question is, a venture capitalist is evaluating a startup that has progressed from the startup stage to a point where it is generating modest revenues but still operating at a loss. The company plans to use the next round of financing to pivot its business model, add new product lines, and exit unprofitable markets. Given this scenario, which type of financing would be most relevant and what strategic considerations should the venture capitalist take into account before making an investment decision? And these options are given to you. Now, first option is replacement finance. The venture capitalist should evaluate the company's asset value and potential for liquidation. Then second option B is buyout financing. And it's given that the venture capitalist should consider the long-term potential of acquiring a controlling interest in the company. Then third is seed capital stage financing. And it's given that the venture capitalist should focus on the R&D capabilities of the company. And last option D is turnaround financing. And here it's given that the venture capitalist should assess the company's new business strategy, cost structure, and management capability to execute the pivot. Now friends, the correct option for the given question is option D, that is turnaround financing. Please note, turnaround financing is suitable for companies that have advanced beyond the startup phase but are struggling to become profitable. In this scenario, the company aims to pivot its business model, introduce new products, and exit unprofitable markets. Now for this strategy, the venture capitalist needs to assess several factors like viability of the new strategy, the company's current cost structure, the potential for market acceptance of new products, and the management team's capability to execute these changes. Next, let's see why other options are incorrect. Now, option A says replacement finance. Friends, this financing is intended for companies needing to replace existing investors or debt, often due to poor performance. It does not specifically focus on strategic pivots or major operational changes, so making it less suitable for a company planning a broad business shift. The next option B says buyout financing. Now friends, this involves acquiring a controlling interest in a company, often through a management buyout or leveraged buyout. Now this financing is not designed to support strategic pivots or operational turnarounds, which is the company's primarily need in our case study. Lastly, option C says seed capital stage financing. Friends, seed capital is for initial R&D phase of startups. And this is inappropriate in our question since the company has moved beyond the initial stage and is already revenue generating. So I hope this explanation is also clear to you. So friends, finally we have reached the last question of our mock test, and the question is from chapter Lease Finance and Hire Purchase. And the question goes like this. Which of the following is a key difference between a finance lease and an operating lease? And these options are given to you. That is, first option is finance lease is revocable whereas operating lease is non-revocable. Then second option B is finance lease typically covers the entire useful life of an asset whereas operating lease covers a shorter duration. Then third option C is maintenance costs in a financial lease are borne by the lessor whereas in an operating lease they are borne by lessee. And last option D is finance lease provides an option to purchase the asset at the end, whereas operating lease does not provide such option. Now friends, please note a finance lease is formed to cover most or all of the useful economic life of an asset, effectively making it similar to purchasing the asset with the benefit of spreading payments over time. Now this type of lease is generally non-cancelable, ensuring that the lessor can fully recover the cost of the asset including interest through lease payments over the lease term. On the other hand, an operating lease is usually short-term, often shorter than the asset's total useful life. Now this makes operating lease more flexible and generally cancelable with notice, providing businesses the option to return or upgrade assets frequently without the obligation of long-term commitment. Also note, in an operating lease, the lessor retains the risk associated with the asset, including maintenance and obsolescence risk. Last but not the least, because lease period is shorter, the asset is typically leased multiple times during its lifespan. Friends, for your examination, please remember this important table. This covers some other important differences as well. Now, as far as this question goes, the correct option is option B. So friends, with this I wind up this video. I hope you found the content beneficial. Also, don't miss out to get your JAIIB Masters pack from the links given in description of this video. The combo pack comes with a discount as well, and you can also get individual books as well as online versions as well. So thank you, and I will meet you again in another video.